Good morning, class. This is ECON 353 Macroeconomics class. Today is March 29th, Tuesday.
The class will discuss the demand side of money in chapter 11. Remember that we discussed the supply side of money in chapter 10. And money is supplied by our Federal Reserve Bank. And now money is demanded by all the people in the nation. And then by considering the demand side of money, we eventually will get the equilibrium interest rate. The interest rate is determined at the intersection of money demand and money supply. So we are going to distinguish the different motive of money demand. Especially, we are going to distinguish between the transaction motive and speculation motive for the holding money. And we are also going to list the variables that influence the demand for money and indicate in which direction the demand for money will be affected by a change in each of them. So here is the order of a video clip we are going to discuss today. 1. Determinants of money demand. 2. The money market. 3. The quantity theory of money. 4. Stocks and bonds. 5. Price of a bond and the interest rate. Here is the first video clip.
The interest rate is the price of money. It's what you have to pay to borrow money from the bank. The interest rate then depends on the interaction of the demand for money and the supply of money. In this discussion, we'll look at what the interest rate is and how it's determined. So let's begin with a question about the demand for money. You, for instance, what determines the amount of money that you hold? What determines the combined balances of your checking accounts and the cash and coins that you choose to carry around with you at any given time? Well, one thing that's going to determine your demand for money is your wealth. And let this green bar represent your overall wealth, all of the things that you own that are of value. The bigger the bar is, the more cash and coins you're going to be carrying around, because you're probably going to be doing more shopping if you're richer. But there's an alternative way of holding wealth besides cash and coins, and that is interest-bearing assets. If you hold cash, then you're not holding bonds and stocks and savings accounts for that matter. And the thing that distinguishes assets from money is that assets earn interest. That is, assets create more wealth for you. So how do you divide your wealth then between assets and money? Well, there are 3 motives for holding money. And each of these motives leads us to think about factors that influence the division of your wealth between money holdings and asset holdings. The first is called the transactions motive for holding money, and that's really why you carry money around, is so you can go shopping. The amount of money that you carry around with the transactions motive is going to depend on 3 factors. The first is real income. The higher your real income is, the more shopping you're going to do, the more stuff there is you're going to buy, and therefore you're going to tend to hold more money. That is, you need more money to actually buy the stuff. A second factor that influences the transactions holding is the price level. The higher prices are, the smaller is the purchasing power of any given quantity of nominal money. That is, your checking account doesn't go as far if prices double. Therefore, you have to load up on money, increasing the quantity of your wealth that you hold in the form of cash and checks. A third factor is the interest rate. And the interest rate, again, is the opportunity cost of holding money. Because when you're holding money, you're not earning interest. When the interest rate is lower, you don't care. You're willing to forego interest in order to have the convenience of carrying around a shoppable medium of exchange. But when the interest rate is higher, you'll tend to shift more of your wealth into interest-bearing forms to take advantage of the higher interest rates. This is the transactions motive for holding money, the trade-off between the convenience of shopping and the opportunity of earning interest on interest-bearing assets. A second motive for holding money that's closely related to the transactions motive is called the precautionary motive. In the precautionary motive, you're concerned about what might happen, the sudden need for money if you were to get sick or decide to quit your job or need to buy a washing machine if the old one breaks. You never know what's going to happen, and the more things that can go wrong, that is, the greater the uncertainty and the greater your anxiety about these things, the more likely you're going to be to hold money. Nowadays, however, the precautionary motive is probably less important. That is because it's easier to convert assets into cash, that is, to convert them into a liquid form or to liquidate them, than it was perhaps during the Great Depression when Keynes first wrote about this motive. Also, people have credit cards nowadays, so you don't need to stick cash in the mattress. If you have an emergency, you can make yourself a loan very quickly with a credit card. The third motive for holding money is called the speculative motive. And the speculative motive is based on your guess about where interest rates are going next. Let's think for a moment about the relationship between interest rates and the value of any given asset. When interest rates rise, that means that there are newly issued securities on the market that pay a higher rate of interest than the securities you may be holding. Higher interest rates mean that nobody wants your old security that pays a lower interest rate, and if you want to sell it, you have to lower the price. You have to sell it at a discount to make it competitive with newly issued securities paying a higher rate of interest. Now you start thinking, if interest rates are very low right now, then they're probably going to go up. That means my securities are about to lose value. And therefore, you may choose to sell the securities now and increase your holdings of cash so as to protect yourself from the consequences of higher interest rates. Since higher interest rates shrink the value of interest-bearing assets, then you protect yourself against that likelihood, that eventuality, by holding more cash now. This is the speculative motive for holding cash, because when you're holding cash, you don't stand to lose when interest rates go up. Now, we can take these three motives, then, and we can draw a demand curve that summarizes these effects. In this demand curve, we're going to put on the vertical axis the rate of interest, the price of money. And on the horizontal axis, we're going to put the quantity of money that you choose to hold. The quantity of money is going to be related to the interest rate through those three motives. And let's go ahead and draw the demand curve for money, downward sloping. The downward sloping demand curve indicates that at higher interest rates, the quantity demanded of money is smaller. At lower interest rates, the quantity demanded of money is going to be greater. That's what makes the curve slope downwards. And the reason for this negative relationship between interest rates and the quantity of money that people want to hold is, first of all, because of transactions. At higher interest rates, people would rather hold interest-bearing assets instead of cash because of the high opportunity cost. So what people do at high interest rates is they take their cash and they purchase interest-bearing assets, converting their wealth into interest-bearing forms. The quantity of money demanded becomes small. At lower interest rates, people don't want to give up the convenience of holding money, so they liquidate or sell their assets and hold cash instead. A second thing that causes this negative relationship is the speculative demand for money. At low interest rates, people are concerned that interest rates may rise and shrink the value of their interest-bearing assets. Therefore, at low interest rates, people protect themselves from this possible loss by selling their securities now and holding cash instead. So between this transactions opportunity cost motive and the speculative fear of rising interest rates, we wind up with a downward sloping demand curve. Lower interest rates are associated with a larger quantity of money demanded. Higher interest rates associated with a smaller quantity of money demanded. Now, we still have two other variables that aren't represented in this picture, and those are the price level and real income. And both of these variables influence the demand for money. In fact, if the price level increases, then people are going to need more cash in order to do their transactions. Their demand for nominal money balances, the amount of money they actually want to hold in their checking account, increases when prices rise in order for them to have enough cash to do a given amount of shopping. Even if you're buying the same number of groceries, you need a larger balance in your checking account if the price of groceries has increased. Therefore, a higher price level means a larger quantity of money demanded at every interest rate. In the same way, a larger real income shifts out the demand for money, because now you're buying more goods and services. When you're wealthier, you're doing more shopping. And even if prices are the same and the interest rate is the same, you're going to want to hold a larger quantity of money in your checking account. You're going to need it to get your given amount of shopping done. When you're wealthier, you do more shopping, and that means holding more transactions balances, a larger demand for money. In summary, the demand for money depends on the price level, the interest rate, and real gross domestic product. These three factors combine to determine the fraction of people's wealth that they hold as cash and checking for shopping, and the fraction that they hold as interest-bearing assets. Now that we understand the demand for money, we're ready to add the supply of money. And with demand and supply, we'll be able to calculate the equilibrium interest rate. You read in the newspaper about interest rates going up and down, and you might ask, what causes that? What changes in the economic environment show up as increasing interest rates or falling interest rates, and what does that mean? Interest rates represent the price of money, and therefore are determined in the market for money. We've discussed how the demand for money is related to the interest rate. That is, how people's decision to hold cash and checking, as opposed to bonds and stocks, is influenced by changes in the interest rate. Now we're going to add the supply of money to calculate supply and demand's interaction to determine the equilibrium interest rate. But first, remember that as the interest rate falls, people choose to hold more of their wealth in the form of cash, that is, money. And lower interest rates, because they represent a smaller opportunity cost of holding cash, make it profitable for people to opt for the convenience of money instead of the return on interest-bearing assets. The downward sloping demand curve represents the movement into money as interest rates fall. What does the supply curve look like in this market? The money supply is controlled by the Federal Reserve. The Federal Reserve determines the amount of money that's appropriate for there to be in the economy in order to make sure there's enough money to make business easy to do, but not so much that prices begin to rise, sparking inflation. The Federal Reserve controls the money supply using a variety of tools that we'll be discussing later. But right now, let's just imagine that the money supply is fixed. That is, the Federal Reserve has sufficient power to make the money supply whatever it wants it to be. In particular, the money supply does not respond to changes in the market interest rate. The money supply may influence the interest rate, but it is not influenced by it. Therefore, we can treat the money supply as fixed. It is a policy variable that the Federal Reserve controls. Because the money supply does not depend on the interest rate, when we draw it in this diagram, it shows up as a vertical line. Whatever the interest rate is, the Federal Reserve gets to choose the money supply that it wants. Now, I can label this vertical curve MS, representing the money supply. Now that I've got a money supply and a money demand curve, I'm ready to move on to the calculation of equilibrium. So, equilibrium, as usual in a supply and demand diagram, occurs where the demand and supply curves touch each other. That is, this point right here, where the curves cross, is going to be the point of market clearing, equilibrium interest rate, I star. In order to see this clearly, let's imagine that we're at some interest rate that's not market clearing, an interest rate where the supply and demand curves are at different places. If we're at an interest rate like I sub 0, an interest rate that's above equilibrium, then the quantity of money demanded at that interest rate is going to be less than the quantity of money supplied. That is, we have an excess supply of money. The Federal Reserve has made available to the market more money than people want to hold at that higher interest rate. So what are people going to do? What they're going to do is they're going to take all of this extra money and show up at their bank, and they're going to want to put it into their savings account. Banks find then that they're overrun, they've got this glut of deposits, and therefore savings account rates begin to drop. The interest rate the bank will pay you becomes less because the bank doesn't need any extra money. As the interest rate begins to fall then, people say, well, I don't want to put my money in savings, I want to hold it in my wallet to do shopping with instead. Because the interest rate is less, therefore the opportunity cost of holding that convenient transactable form is less. So that will resolve this excess supply. As the interest rate falls, then people demand a larger quantity of money, and eventually, as the interest rate gets to I star, the market is going to clear. Now, another way of telling the same story is whenever people say, I've got too much cash at the going interest rate, they go and they buy bonds with it. When everybody wants to buy bonds, they're bidding up the price of bonds. And as the price of bonds gets higher and higher and higher, the rate of return on bonds gets smaller. That is, if this bond pays you $10 a year and you can buy it for $100, that's a 10% rate of return. But if you have to pay $200 for the same bond, that's only a 5% rate of return. So as the price of bonds rises, as people aggressively compete for bonds, trying to get rid of their extra cash, they drive up the price of bonds, and that's the same thing as driving down the rate of return, or the interest rate. As that interest rate falls, people then decide that they'd rather hold cash instead. Consider the other possibility, that the interest rate is below equilibrium. If the interest rate is below equilibrium, say at some level like I1, then the quantity of money demanded on the demand curve is greater than the quantity supplied. That is, we have an excess demand for money. People say, hey, interest rate's so low, why shouldn't I carry cash? It's not worth the hassle to deal with the bank account. The return isn't high enough. So what happens in that case is everybody goes to their savings account and wants to withdraw cash from it so they can carry the money around. Banks then are running short on savings. They don't have enough money in their banks to make their loans, and in order to attract savings, banks begin to aggressively compete, raising the interest rate on savings accounts, and as they do so, people decide, oh, banks look attractive again, and they come back to put their cash in. See, the point here is that as banks bid up the interest rate, people decide that they would like to economize on their cash holdings to take advantage of these rising rates, and the quantity of money demanded declines until the equilibrium is reestablished at I star. Alternatively, people down here say, the interest rate is so low, who wants to hold a bond? Everybody decides to sell their bond, and when everyone sells their bonds, the price of bonds is pushed down. When the price of bonds is pushed down, the rate of return on bonds is pushed up. Remember that bond that pays you $10 a year? Well, at $100 for the bond, that's a 10% rate of return. But if bonds lose value, that is, if their price drops to $50, now that's a 20% rate of return when you get that $10 check annually. So, whenever bond prices are falling because people are trying to get rid of their bonds and get cash instead, the interest rate on bonds, the rate of return is bid up until finally people decide, yes, they're just as happy holding these bonds because the interest rate is back at a level that gives us equilibrium. So, what happens then in this market when something changes? We've looked at supply and demand and equilibrium. Our last challenge is to do some comparative statics exercises. That is, what happens when the curves shift? Well, let's think about a few things that would shift the curves. First of all, what would shift the demand curve for money? Well, if the price level were to increase, everyone would need to hold more cash to do their shopping. Therefore, the demand curve for money would shift outwards. With the demand curve for money shifting outwards to a new level, the old interest rate, I star, would create a situation in which we have excess demand for money. At this old interest rate now, there's a larger quantity of money demanded than there is supplied. So that creates a bidding process. Banks start to compete to hold on to their savings accounts, and the interest rate rises to restore equilibrium. If the price level increases, then equilibrium interest rate rises. The same thing is going to be true if real output increases. If real output increases, the demand for money increases across the economy. People need more cash and checking accounts to do their business, and everyone shows up at once wanting to sell their bonds and get cash instead. When everybody tries to sell their bonds, once again, interest rates are going to be bid up. The same thing if everyone tried to withdraw from their savings account at once. Banks would find themselves scrambling to hold on to their deposits. Interest rates would be bid up, and a new higher equilibrium interest rate would be established. So as far as the demand curve is concerned, a higher price level or a higher real gross domestic product will increase the demand for money, and either of these developments will push up the equilibrium interest rate. The final thing that we could do is we could shift the money supply curve. If the Federal Reserve decided to increase the supply of money, we'd get a new supply curve, maybe out at a point like this. And if the Federal Reserve were to increase the money supply to a new higher level, then at the old interest rate I star, look, we've got a much bigger supply of money than we have demand for money on the original red curve. Well, people have now got more money than they want, and what are they going to do with it? They're going to show up at the bank and want to deposit it, and when everybody deposits at once, the bank finds itself glutted with savings deposits, and that pushes the equilibrium interest rate down. An increase in the money supply creates excess supply of money at the original interest rate, and people's behavior at that point is going to be to go out and seek interest-bearing assets because they don't want any more cash. When everyone does that, the price of bonds is going to be bid up, pushing down the rate of return, and banks are going to find themselves glutted with savings deposits, so they'll lower their interest rates. Therefore, an increase in the money supply leads to a lower equilibrium interest rate. Whatever direction the money supply changes, the equilibrium interest rate changes in the opposite direction. So now you can do your own experiments. There are really three variables that can change in this story: the price level, real gross domestic product, and the nominal money supply controlled by the Fed. Anytime one of those variables changes, you'll get a change in the equilibrium interest rate through an interaction of money supply and money demand. So I just bought some groceries and I got this dollar in change and it says Lucy on it. Now, I have no idea who Lucy is, but Lucy, wherever she may be, has made me think about the fact that any given dollar bill gets spent and respent and spent again in the economy in the process of our goods and services changing hands. It makes me think about the relationship between money and real goods and services. What's the connection? And this is a really important question because it's at the heart of the question of whether the Fed can really influence the economy or not. Here's the question: what's the relationship between paper money, which is nominal, that is imaginary, and real goods and services, that is stuff that we actually buy at the store that satisfies our wants and needs? Is there a connection between the nominal economy, the money economy, and the real economy? And if so, what is it? Well, we're going to start right now with a very pessimistic look at this relationship. And this comes from the classical economists, the heirs of Adam Smith. The classical economists are the people who gave us supply and demand diagrams and prices that adjust instantly to clear markets. In the view of the classical economists, there is no relationship between the nominal economy and the real economy. Money is neutral. If you increase the money supply, all you do is increase the price level. You don't change the real quantity of goods and services. You don't change the standard of living. You don't change employment or output or investment or any of the real variables in the economy. All you do is increase prices proportionally. Let's see where the classical economists got that conclusion. We go back to this equation that explains the relationship between money, prices, and real output in the economy. This is called the quantity equation. And the quantity equation is quite intuitive. It says that all the shopping that's done in our economy, the gross domestic product, has got to be paid for somehow with the money supply. Whenever you go shopping, you pay for whatever you get with cash or checks, and that's the money supply. Now, the money supply in our economy is about $1 trillion, and the gross domestic product is about $8 trillion. That means that every dollar bill circulating in our economy, on average, is being spent and respent 8 times during the year to make this equation balance. All the shopping has to be paid for, and since the money supply is less than the gross domestic product, that means dollars are spent and respent, and the rate of respending is called velocity. Well, the classical economist said, look, consider this reasoning. If the velocity of money is constant, then any increase in the money supply shows up as either an increase in the price level or an increase in real output. However, real output is governed by the speed limit of the economy. That is, there's full employment output. And if you try to have more output than full employment, prices go right up. And if you try to have less employment than full output, then you've got slack in the economy and wages and prices fall. So if you believe that wages and prices adjust instantly to keep supply and demand in balance, if you're a classical Adam Smith schooled economist who believes that prices do all the work in the economy, adjusting up and down to make supply and demand balance, then you believe that any change in the money supply is going to immediately feed into a change in prices with no change in the real economy. This is what's meant by the statement, money is neutral. If we say that money is neutral, we're speaking from a classical point of view. Increasing the money supply by 10% only increases the price level by 10% with no change in real output. Nothing changes. Output, investment, employment, all that stuff that we really care about, the whole real economy, the economy of goods and services, remains unchanged. The change in the money supply influences only nominal variables. This is what's called the classical dichotomy. The world of money is completely separate from the world of goods and services. That is, the real economy is disconnected from the monetary economy. Now, that's a very extreme position, and most economists nowadays believe that changes in the money supply, at least in the short run, can influence output as well as prices. But in the long run, the classical position holds. That is, even in the models that we use nowadays that allow some latitude for money to affect output, in the long run, all of the effect goes into a change in prices. And we'll see that shortly. But first, let me give you an example of what a time series would look like following a change in the money supply. Suppose we're in a world where the money supply can have an influence on output in the short run. And this is certainly the case. I mean, in 1992, when the Federal Reserve had encouraged banks to lend more money to businesses and end the credit crunch that followed the banking crisis of the 80s, what happened was interest rates fell and businesses began borrowing and beefing up their capital stock, building more factories and buying more equipment. So in the short run, with the increase in money supply, there was an increase in output. Here's what it looked like. The Fed was clipping along here with a money supply at a fixed rate. And notice here, I'm using movement along the horizontal axis to indicate the passage of time. So time passes as this line flows to the right. And here we are with the Fed making the decision to increase the money supply, let's say by 40%. So the Fed increases the money supply, and this new money supply just clips along for the rest of time. Well, what's going to happen in the economy? What would really happen is that output would begin to increase because of the availability of credit. Businesses can borrow easier, interest rates are lower, and output increases, but then at some point prices begin to increase. And when they do, the demand for money increases, and with the increase in demand for money, interest rates rise, people stop spending as much, consumers don't like the higher prices because it shrinks the real value of their wealth, and foreigners stop buying our stuff because other goods from other countries are less expensive. So the rising prices then choke output back to its full employment level, and output goes along. There's been a temporary blip here, a little stimulus to the economy from the monetary policy, but nothing enduring. In fact, what happens is prices clip along at their regular rate, and then with the increase in money supply, prices begin rising, and they rise until they get to their new level, which is going to be proportionally equal to the increase in the money supply. So if the money supply goes up by 40%, then in the long run, prices are also going to rise by exactly the same amount, 40%, and output is going to be unchanged. That's because output in the long run has to respect the speed limit. And that if we're above the speed limit, prices are going to rise until we're brought back to the speed limit, as we've seen in our other models. So, how long does this process take? How much of an increase in output are we going to get? Listen, even if it doesn't last forever, it's better than nothing, right? Can monetary policy have an effect in the short run, even if it can't have an effect in the long run? Well, that depends. It depends on how quickly people digest the future. If people are forward-looking, forming rational expectations of what's to come, they're not going to be fooled at all. This increase in the money supply, they know, is going to very quickly create inflation. In fact, they may even act in anticipation by raising their prices now. They say, uh-oh, money supply up 40%. That means prices are going up 40%. I better raise my prices now. Labor unions negotiate for higher wages. People try to raise their prices so they're not caught behind with their rivals raising their prices before them, and what we might get is an instantaneous adjustment of prices with no period of higher income at all. This is the extreme view in which monetary policy can have no effect, not even in the short run. If expectations are rational, we're more likely to have the case here represented by the dotted lines, where all the adjustment is instantly on the side of prices, with no change in real output at all. So, back to our original question. Can money make a difference in the real economy? Can a change in the money supply influence output, employment, and investment? And the answer is, it depends. In the long run, clearly not. The nominal economy in the long run influences only the nominal economy. In the short run, however, it's possible, but only to the extent that people do not perfectly digest the future, don't perfectly change their behavior in response to what they see coming. To the extent that they do, money has no effect at all. It's perfectly neutral. But to the extent that people are fooled or slow to change their expectations, money can, in the short run, have an effect on the real economy. Look, I've got this great investment opportunity. I think it's going to make a bundle of money, and all I need to get it started is $5 million. Unfortunately, all I have is $1 million, and unless I can come up with another 4, then this opportunity is going to go to waste. So where am I going to get the capital I need? Who is going to lend me the money that I need to take advantage of this wonderful opportunity? Well, I'll put my $1 million aside for the moment, and I'm going to go and see if I can borrow some money. There are 2 forms in which I can borrow. I can go get debt, or I can issue equity. Debt means going and borrowing money, promising to repay it with a fixed interest payment at a date in the future, kind of like when you borrow money from the bank. Equity, on the other hand, is selling shares in the profits of my venture. That is, if you own a share of equity in my company, you're entitled to a fraction of the profits when and if the venture makes a profit. So let's see how I might arrange things. Suppose I go and I try to acquire debt by selling bonds. A bond is a financial instrument that entitles the holder to a repayment in the future. This repayment has 2 parts. First, you get a repayment of your principal. Principal is the money that you originally lent to me for this project. In addition to getting your principal back, you get interest. And interest is an extra bit of money, a reward that compensates you for your patience and for the risk that you're taking. This interest payment covers the opportunity cost of the money to you. After all, you've got your own ideas, and if I pay you enough interest, then you'll find it more profitable to lend to me and my venture than investing in your own. So, suppose I go to some people and I get them to lend me $2 million. And $2 million, they say, will require a 50% interest. That is, they want $3 million back in a year whenever this project pays off. So let me go ahead and add up. So far, I've got $2 million raised, and I've raised that in the form of issuing debt. Okay, now my other option is I can sell equity. Well, one of the things I'm thinking is I'd kind of like to get a piece of this action myself. I mean, it's my project, and therefore I'm going to hold $1 million worth of the stock in my company. Now, $1 million means that 1 million plus the 2 million I've already got is 3 million, which means I need another 2 million to pull the project off. That means I need to sell $2 million worth of equity for a total of 3 million to add with the debt and have the money I need to get started. So 1 million, my share, is 1/3 of the total of $3 million that I need to raise by selling equity. So here's the way I'm going to think about it. I'm going to hold 1/3 or 33% of the equity in this venture. That is, I hold 1/3 of the stock in this venture that I'm about to undertake. Then I'm going to go find another investor who likes my idea and get him to give me $2 million, which will be 2/3 of the equity. See, 2 million plus 1 million is the 3 million I need. I put in 1/3 of it, he puts in 2/3. So I hold 1/3 of the equity, he holds 2/3. I'm entitled to 1/3 of the profits that are left over after we've paid off our debt. He's entitled to 2/3. So let's put my equity into the pot. Let's put his equity into the pot, and now we've got $1, $2, $3, $4, $5 million. That's enough to pull this project off. Well, let's see if we get lucky. Here's my project, and I'm going to pour the capital in and see what comes out. And I'm feeling lucky, and let me see how this project pays off. So, oh, come on, baby, come on, come on. And that's it. That looks like all we've got. So, looks like we've got 1, 2, 3, 4, 5, 6, 7, 8, $9 million came out of this project. Well, of this $9 million now, we know that we've got to pay off our debt first. And that means, let's see, 1, 2, 3, that's our $2 million worth of principal plus $1 million worth of interest. Remember that 50% interest contract, which means we've got to give 3 of these million to our bondholders. And that's that. Now that leaves for equity, we get all this rest of the stuff that's left. This is the gravy on our project, and we get to keep it, and I get 1/3 of it, and since there's a total of 6 million left, 1/3 of 6 million is 2 for me, and my other equity investor gets a total of 4. Well, that's the way it goes. See, I put in 1 million, I ended up with 2 million, I made a 100% return. Whoopee! The equity holders did really well because this project was highly profitable. Now, of course, all projects don't turn out that way. We could have put in our 5 million, and under other circumstances, we could have gotten a different kind of payoff. Let's see what would have happened if our project had not have been quite so successful. Come on. That's it. And it looks like in this case, we made just enough to pay off our bond. Well, in that case, all the money goes to service the debt, and equity gets nothing. There's nothing left for equity. That is, we put our million in, he put his 2 million in, and in the end, we got nothing. Sometimes that happens because when you hold equity, you're taking the risk. Bondholders get paid first. That's the way the law works. The nature of a bond contract is you get the prior claim on the returns on the project. If there's a loss to be made, equity takes it first. Well, let's suppose that we put all that money into the project, and instead, nothing had come out. Well, in this case, not only is the equity worthless, but the bond defaults. See, the last people to lose money in the event of the worst possible outcome are the bondholders. And if there's a default, then the bondholders suffer. See, even though the bondholders have first claim on the returns on the project, it doesn't mean that they're without risk, because in some cases, there'll be such an extreme outcome that the bondholders will get nothing as well. Well, with this little story, we can see then something about how debt and equity work. See, bonds have a principal, the money that you borrow, and an interest payment that you promise to pay when the project is over. Because of the possibility of default, because this is still a risky investment, the riskier the investment is, the higher the interest rate the bondholders will demand to lend you money, because they're afraid of getting stuck with a default in certain circumstances. Now, some bonds, called junk bonds, are bonds that you are intentionally gambling on. They pay very high rates of interest because their default rates are especially high. These are highly speculative ventures that are financed with debt financing, with full understanding that default is certainly a possibility. There are also perpetuity bonds, bonds that are issued that pay you money every year from now on. These bonds are kind of like annuities. That is, they pay you the money every year and they never mature. The maturity date is the date on which the bond repays you your original investment, the date on which you get your principal back. Bonds are issued by corporations, by the United States government, by state and county governments, by city governments. Bonds issued by city and county governments are called municipal bonds, and their interest is tax exempt. Bonds are also issued by households. They're called mortgages whenever you borrow money long term to build or buy a house. And that's the way debt finance works. Things that determine the interest rate on a bond are going to be its risk, the length of time that the borrower wants to borrow the money, and any tax consequences. That is, municipal bonds typically have lower interest rates because you pay fewer taxes on that interest. Now, let's think for a moment about stocks. Stocks, unlike bonds, never mature. When you own a share of stock, you own a piece of the equity, a piece of the profits of that company. And therefore, as long as this company is in business, whoever is holding the stock is going to get the profits anytime they're distributed. A distribution of profits is called dividends, whenever profits are paid out to the people who are holding the equities. Sometimes when you hold stock, you don't receive dividends. What would be your dividends are simply reinvested into the company, increasing its value and increasing the value of the stocks that you hold. Anytime you sell a stock for a higher price than you paid for it, what you get is called a capital gain. The extra money in excess over the original purchase price is your capital gain, or reward for holding the stock when its price goes up. If the price goes down over the holding period and you sell the stock at a loss, that's called a capital loss, the difference between the selling price and the original price at which you purchased the stock. Stocks are traded on markets such as the New York Stock Exchange, which is an ongoing auction market where buyers and sellers meet, constantly trading the stocks. When the stock is originally issued, it's called the primary market. When IBM or some other company uses an investment banker as a broker to sell stocks to mutual funds and private investors, we call that a primary market transaction. But if you take a share of IBM stock and sell it to me, perhaps through agents on the New York Stock Exchange, we call that the secondary market. IBM doesn't get any additional money, but you and I can profit by trading based on our different expectations of what's going to happen to the value of the stock. The Dow Jones Industrial Average tells you about the average price of 30 important stocks traded, perhaps on the New York Stock Exchange or perhaps on other exchanges. But it's a general measure of what's happening to stock prices day to day. There are other general measures, such as the Standard & Poor's 500 or the Wilshire 5000. These are different indexes that give you averages of stock prices, and as they move up, generally it means that people are bidding higher prices to hold the equities of companies. Other stocks are traded over the counter, that is, on a computerized network that doesn't involve a constant ongoing auction. They're traded at fixed quoted prices that brokers enter into computer terminals and broadcast to all interested parties. The most important over-the-counter market is the National Association of Securities Dealers Automatic Quotation Machine. That's called NASDAQ. The NASDAQ system is a network on which stocks of usually younger companies, and especially nowadays tech companies, are traded. So the NASDAQ, the Dow Jones Industrial Average, the New York Stock Exchange, all of these are institutions that support the exchange of equities of companies. So one final question. Why would you choose to hold equity in a company when you could hold debt instead? And the answer depends on how much risk you want to take. If you hold equity, there's a big possible upside. You may double your money. If, on the other hand, you hold debt, you can never make more than the stated interest rate that is written on your debt contract. Equity, on the other hand, is limitless in its possibility. The more successful the company, the higher your possible return. But you're always going to worry about the risk of failure. Bond prices and interest rates are inversely related. To understand this relationship, you first have to understand what a bond is and how they work, and then you have to be very clear on what an economist means when he or she refers to the interest rate. Let's start by thinking about a bond. A bond is defined by 4 factors. First, its face value. The face value is usually $1,000, and this is the amount of money that you receive if you're holding the bond on its maturity date. The second thing is its coupon rate. The coupon rate is the rate at which the bond pays you interest. If the coupon rate is 20%, then you receive 20% of the face value every year in interest payments. So, for example, a bond with a $1,000 face value and a 20% coupon rate pays you $200 a year in coupon payments. The next thing is the bond's maturity date. The bond's maturity date is written on the face of the bond, and that's the date at which you are paid the face value, as well as the final interest payment. So, for instance, if this bond matures on the 31st of March 2001, then on that date you will receive the final interest payment of $200, and you will receive the face value of $1,000. At that point, the bond is finished. So suppose you're considering making an investment, and it's March the 31st in the year 2000. If you buy this bond today, whatever price you pay for it, then 1 year from now, on the 31st of March 2001, you will receive $200, the final interest payment, plus the face value, for a total of $1,200. Now, think about the rate of return on your money. It depends completely on how much money you pay to get this bond. If you could get it for a small price, then $1,200 is going to be a huge return. But the closer the amount you pay is to $1,200, the less interest, the less profit you're making for the year that you hold this bond. To understand this inverse relationship between price and return, think of a bond as a candy bar. Now, here's how it works. A year from now, you're going to get this candy bar. That's what it means to own this bond. And this candy bar, as we've seen, is $1,200. Now, how much are you going to pay today to get this candy bar? Suppose you pay $600 to get this promise of $1,200 in a year. That means $600, what you originally pay for the bond, is your principal, how much you've invested in this opportunity. A year from now, when you get $1,200, you're going to break off $600 and call that the repayment of your original investment. The remaining $600 is your reward, your profit, and we call that interest. Calculate the interest rate by dividing the interest payment by the principal. In this case, $600 divided by 600 gives you a rate of return of 100%. On the other hand, if you pay $900 to get this candy bar, then $900 of the $1,200 repayment is just repaying your original investment. That means only $300 is profit or interest. 300 divided by 900 is an interest rate of 33.33%. Notice as I move the bar over, as the price of the bond went up, the interest rate got smaller. Finally, suppose you actually pay more than the face value for the bond. Suppose you pay $1,050 to get this candy bar. That means $1,050 is a repayment of your principal, and only $150 is interest, for an interest rate of about 14.25%. So I think it's very clear that as you pay more for the bond, a larger share of the money that you get counts as repayment of your principal, leaving a smaller and smaller piece of the candy bar as interest. As the price goes up, the rate of return or interest rate falls. Let's think again about the relationship between prices and interest rates. But now I want to call your attention to the different ways in which economists use the term the interest rate. One of the things that people mean when they say the interest rate is the coupon rate on the bond, in our case 20%. Another thing that they may refer to when they use the term interest rate is the actual rate of return on the bond. If you bought the bond for $900, then your interest rate, or your true rate of return, is 33.33%. Let's look at how that works in a simple demonstration. Consider the way a seesaw works. You know that famous piece of playground equipment? It's got a fulcrum here and an horizon. On the right-hand side, we're going to put prices. On the left-hand side, we're going to put interest rates. Over here, let's start by putting the face value of the bond. And let's suppose that, as is the case with most bonds, the face value is $1,000. That face value over here is going to be balanced by the coupon rate. And let's suppose that the coupon rate is equal to 20%. Now, these things are part of the definition of the bond. Because the bond is going to pay you $200 every year, that's 20% of the face value of $1,000. Now, you're probably not going to pay $1,000 for this bond. When the bond trades in the secondary market, its price will go up and down depending on people's alternative investment opportunities and depending on people's assessment of this company's creditworthiness. So, in order to represent the price of the bond in day-to-day trading, I'm going to put a teeter-totter on this seesaw and let the board move around. So, for instance, we saw in our previous calculation that if this bond is trading at a price of $1,050, the actual interest rate or rate of return on this investment is 14.25%. Notice that when the price is above the face value, the rate of interest, the true rate of return, is below the coupon rate. On the other hand, if the price of the bond were to be below the face value, say $900, as in one of our examples, the interest rate is above the coupon rate, 33.33%. Anytime the price falls, the interest rate rises. The rate of return on the bond is higher. And anytime the price rises above the face value, the rate of return on the investment drops below the coupon rate. Now, this brings me to the third way that economists sometimes use the term interest rate, to refer to the alternative investment opportunities. That is, what is your opportunity cost for buying this particular bond? What interest rate are you giving up? That is, what could you earn if you took your money to a bank or bought another bond instead? We refer to the best available return as the market interest rate. That is what you could earn on an investment of comparable risk and comparable tax treatment. Another investment that is in all other important ways identical to this particular bond. Because, see, this bond has to be competitive with the market or no one will buy it. If the market interest rate is high and this bond is only paying you 20% and people could earn 33.33% on another investment opportunity, then this bond will have to sell at a lower price in order to make it competitive with what people could earn elsewhere. That is, when the market interest rate goes up to 33.33%, the price on this bond has to drop to $900 to make this particular bond competitive with alternative investment opportunities. On the other hand, if the market interest rate goes down to 14.25%, then this bond can sell at a premium. That is, the bondholder could charge $10.50 for the bond because that way the person buying it is earning the same return that he could get somewhere else. So think of the market interest rate as that famous bully on the playground who would come and grab one end of the seesaw and just push it around while you're stuck on the other end and just decide where he wanted you to go. The market interest rate pushes the price of this bond down or pulls it up whenever the price of the bond has to adjust to be competitive with other opportunities in the market. So, bond prices and interest rates are inversely related. First of all, they're inversely related by definition. A bigger a chunk of the bond's repayment, a bigger a chunk of the bond's money counts as repayment of your original principal investment, leaves a smaller piece to be interest. So there's a mathematical necessity in this inverse relationship. The second thing is, if the market wants this bond to pay a higher interest rate, that can only be accomplished by discounting the price. And if the market wants this bond to pay a lower interest rate, that's accomplished by selling the bond at a higher or premium price. Now, the last thing we want to touch on is this notion of present value. Present value talks about the relationship between the value of money received today and the value of money received in the future. For instance, suppose you have a certain amount of money today, maybe $1,000, and you put it in the bank earning 10% interest. The value of the money 1 year from now will be the present deposit multiplied by 1, your principal, plus I, the interest rate. So if you put $1,000 in the bank today, 1 plus 10%, the interest rate, means a year from now you'll have $1,100. $1,100 is the future value of $1,000 deposited today when the interest rate is 10%. Well, what about further years in the future? The value of the money 2 years from today is going to be equal to the value of the money 1 year from today, compounding the interest one more year. That is, if you multiply 1,100 by 1 plus 10%, you'll have $1,210. That's the value of $1,000 today, 2 years from now, when the interest rate is 10%. So you could write that as 1 plus the interest rate squared, multiplied by that deposit today. To find the future value, take the amount of money you have today and multiply it by 1 plus the interest rate raised to the power of the number of years that you're interested in, whether 1, 2, or n. Now, consider the same calculations done in reverse. Divide both sides of the equation by 1 plus the interest rate, and what you're answering is, what is the value today of money that you don't expect to receive till the future? Now, why does future money have any value today? The answer is because you can borrow against it. And a year from now, when you actually get that money, you can repay your loan with interest. But because you have to leave room for interest to accumulate, the amount of money that you can borrow today is less than the amount of money you expect to receive in the future. For instance, suppose you're going to get $1,000 in the future. How much could you borrow today if you've got to repay the loan with 10% interest? The answer is, divide $1,000 by 1 plus 10%, and you'll get about $909. Borrow $909 today, and a year from now, you'll owe $1,000, just in time to repay your loan with the receipt that you get in the future. So the present value today of $1,000 that you're expecting to get a year from now, when the interest rate is 10%, that present value is $909. In general, the present value of any amount of money is going to be that amount in the future divided by 1 plus the interest rate raised to the power of the number of years you have to wait. This compounding down here in the denominator is called discounting when we're calculating present value. And this discounting takes into account the accumulation of interest between today, when you would borrow the money, and the future, when you actually receive the money and pay off the loan. So when you hear people talking about present value, think about this: the amount of money you could borrow today against an amount that you're going to receive in the future when you know what the interest rate is. We've seen how banks, in their pursuit of profit, create money. Banks make loans so they can earn interest. And when they make loans, they create checking accounts. And checking accounts are part of the money supply. However, the Fed is really running this whole show because it's the Fed that determines how much reserve a bank has to hold against its checking accounts. For instance, whenever a bank offers a new checking account, every dollar in checking has to be backed with 10 cents worth of reserves, whether cash in the vault or deposits at the Fed. And since the Fed gets to determine this reserve ratio, and the Fed gets to determine how much reserves are actually available to the banking system, it's the Fed that's really driving the process, even though banks are making the decision about how many new checking accounts to create as they make loans. Let's think now about how the Fed can use its power to influence the money supply. And there are 3 important policy tools that the Fed uses as it seeks to increase or decrease the money supply at any given time. The first policy tool is the required reserve ratio itself. That is, the Fed can decide whether the banks have to hold 10 cents in reserves, or 20 cents in reserves, or 50 cents in reserves for every dollar in checking that the banks offer. Consider an extreme case. What if a bank had to hold 100% reserves? That is, suppose for every dollar that the bank offers in checking accounts, the bank has to hold $1 in cash in its vault. Well, if this is the case, banks can't create any new money. That is, if I make a deposit in my bank and the bank gives me credit in my checking account, the bank has to hold my cash in the vault and can't lend it out. In this case, the bank is unable to create new money, and there is no money multiplier. Now, the Fed is not going to create such an extreme case because the Fed likes the banking system to have the latitude to create new money or to create fewer loans in response to changes in the demand for money. So the Fed wouldn't create such an extreme case. But suppose the Fed does change the reserve requirement. Say it changes it from 12% to 10%, as it did in the early 1990s. When the Fed does that, banks suddenly find that they don't need all the reserves that they're holding in their vaults. And then they immediately lend out the excess. That is, if they want to make a profit, they immediately make new loans so they can earn interest. Whenever the reserve requirement shrinks, the money multiplier expands. That is, banks need to hold less of what's deposited there so they can make more new loans anytime they receive new reserves. When the required reserve ratio goes up, banks are not able to make as many new loans, and therefore the money multiplier is smaller. When the required reserve ratio shrinks, then banks are able to lend out more money because more of every new deposit is excess. Now, the required reserve ratio, because it affects the money multiplier, is a very, very powerful tool, and the Fed rarely changes it. The Fed has increased the required reserve ratio, as it did in the early 1980s, in order to reduce the money supply precipitously in the environment where there was a lot of inflation. So an increase in the reserve requirement shrinks the money supply very fast. In the early 1990s, the Fed lowered the reserve requirement because the economy was in a recession, and the Fed wanted to make credit easier to get so businesses would expand. But the required reserve ratio, changes in it, is the least frequently used policy tool of the Fed because it's the most powerful. For the same reason that you don't go get a sledgehammer to swat a fly, the Fed doesn't change the reserve requirement when it wants to make small adjustments in the money supply. The second tool that the Fed uses is historically interesting but not so important nowadays, and that is changes in the discount rate. The Fed makes discount loans to insured depositories. That is, any bank, credit union, or savings and loan that has insurance through the Federal Deposit Insurance Corporation or one of the other federal depository insurers is able to come to the Fed and borrow money when it needs it. Now, in the early days, the Fed operated as the lender of last resort. That is, whenever a bank was finding people withdrawing money rapidly and in a liquidity crunch and in danger of failing, the Fed would lend this institution money at a very low interest rate in order to prevent its failure and help to protect the money supply. However, nowadays, banks have other places they can go to borrow when they need it. They can borrow from one another through what's called a federal funds market, or they can use some of the treasury bills that they hold and sell them in order to get cash. So since they don't have to borrow from the Fed, banks do so very, very infrequently. For the same reason, you don't want to borrow from your parents. I mean, you get a good interest rate, but they're going to ask you a lot of nosy questions. The Fed comes in and audits banks that borrow from it, because if you're borrowing from the Fed, that's a bad sign. It means other people won't lend you money. So discount loans, although they were important in the early days of the Fed, nowadays are less important. In fact, the discount rate, which the Fed changes ever so often, is viewed as largely symbolic. Increases in the discount rate signal to the financial markets that the Fed is tightening the money supply. But since few banks are borrowing at that rate, it's not especially important as a policy tool. The final tool that the Fed uses is what's called open market operations. Open market operations refers to the purchase and sale of government securities. The Fed holds about $400 billion worth of U.S. government debt, and it can buy and sell government debt as it wants to change the money supply. This is the most frequently used policy tool of the Fed. In fact, every business day, the agents of the Fed are in the financial markets buying and selling government securities to change the money supply. So you see that all of the tools of the Fed operate on two different directions in creating money. Either they change the amount of reserves that are available to the banking system by lending banks more reserves, or by providing money to people who deposit in banks, thereby creating reserves. Or they change the reserve requirement, giving banks more room to create loans with a given amount of reserves. Let's look finally at how these policy tools show up on the balance sheets, first of the Fed and then of the banks. Look at the Fed's balance sheet. The assets of the Fed include the government debt, and the liabilities of the Fed include the reserve deposits of banks. So the Fed has reserve deposits over here that it owes to the banks that have made them. And the Fed over here has assets such as Treasury bills and loans, that money that the banks owe to the Fed. When the Fed does a discount loan, what happens is the Fed gets an asset over here, and the liability is an increase in bank reserves. So banks now have more reserve credit at the Fed. When the Fed does an open market operation, say the Fed buys a government security, then the Fed acquires Treasury bills. And whenever it writes a check to some trader in the public, and that trader deposits it in his bank, then the bank gets reserve credit at the Fed. Let's see now how this actually creates money by looking at a bank balance sheet that we did earlier. Suppose the Fed buys a government security from some trader. That is, the Fed writes a check for $1,000 to you whenever you sell a Treasury bill to the Fed. You take the check to your bank and deposits it. So the bank now gives you credit in your checking account for that $1,000 check that you deposited from the Fed. When the bank presents it to the Fed, the bank gets $1,000 in reserve credit. Now, the bank doesn't have to hold all of that money, and if the reserve requirement is only 10%, the bank can lend out 90%, which it does. It creates a loan for $900. And that $900 loan is created in the form of a new checking account for someone, say person number 2. This is the step at which the bank actually creates money. The open market operation pumps new reserves into the banking system and gives the banks more room to create more money. Of course, then, the person who got that loan immediately spends it, and the reserves flow to another institution, setting up a multiplier process. So that's the way the Fed works. Now, the multiplier process may not be as strong in theory as it is, or in practice as it is in our theories, for 3 reasons. First, banks may not want to lend out all of the reserves that they're able to. That is, even though they can lend out 90%, they may only lend out 80% and keep 10% in excess reserves. Banks do this if they can't find high-quality loans, or if they're afraid the economy might turn down and they get stuck with a bunch of non-performing loans. A second concern is households may not choose to put all the money in the bank. Suppose whenever you get this check from the Fed, you go in and cash it, but you don't put it all in your checking account. You hold it in currency instead. As long as it's outside the banking system, it doesn't count as bank reserves, and that limits the number of new accounts that banks can create. Finally, there's another concern that keeps the Fed from having such tight control over the money supply, and that is that there are things that count as near money. Repurchase agreements, large CDs, savings accounts, over which the Fed does not have nearly as much control. The reserve requirement is directly aimed at checking accounts. And these near monies, these other kind of liquid ways of storing wealth, may increase or decrease without as much direct control from the Fed. And when that happens, then people may change their shopping behavior using mediums that the Fed is not directly controlling, and that limits the Fed's ability to as tightly fine-tune the economy as it might like. We have made a big deal out of the fact that in macroeconomic equilibrium, savings equals investment. Remember these equations? Your income and its uses, spend, save, or pay taxes, and aggregate expenditure, which in equilibrium has to equal income. Set income equal to income, and with a little algebra, you derive this remarkable equation, which says that in equilibrium, savings equals investment. That is, all the money that businesses borrow to build new factories and buy new equipment has to come from people's savings, whether households, the government, or foreigners. But what makes this happen? Usually, this kind of equilibrium comes about because of the adjustment of prices in a market. And this case is no different. The money that businesses borrow and the money that people save is brought into equilibrium by adjustment in the interest rate. The interest rate changes so as to make the quantity of funds saved equal to the quantity of funds borrowed. Let's see how this works by looking at a supply and demand diagram. The supply and demand are going to be savings and investment. We'll start with the demand for loanable funds, which is the money that businesses want to borrow. Then we'll look at what people want to save, both of them influenced by the interest rate. Now, when you draw a supply and demand diagram, you've got to be very clear about what's on the axis. On the horizontal axis, we put quantity, and in this case, it's the quantity of loanable funds. Since we're going to talk about demand first, we're going to label this axis with capital I, investment spending, because this is businesses wanting to borrow money, the demand for loanable funds. On the vertical axis, we have the price of loanable funds, which is the interest rate, what you have to pay to borrow money. Now, this brings up a point that can cause some confusion, so stay with me for a minute, and that is the difference between the nominal interest rate and the real interest rate. The nominal interest rate is the interest rate that's written on the sign at the bank, what you get paid for your savings account. Say 10%. You leave $100 in the bank today, and next year you can take out $100 plus 10% interest for a total of $110. But that's not really what people care about. They don't really care about what's on the sign. They care about their purchasing power. I care about this. I'm going to put in $100 in the bank today. That means I'm giving up a pair of shoes. I want to know next year when I take out $110, what can I buy with it? A pair of shoes and a cool pair of socks? Or maybe prices have gone up by so much that I can't even afford the shoes anymore. Maybe now I have to settle for something less. So the question is, what happens to my purchasing power? Because what's going to happen to my purchasing power determines whether I want to save money or whether I want to spend it today. Let's look at Irving Fisher's equation. We've seen this before, that the nominal interest rate, that is what the bank pays you, is equal to the real interest rate plus the rate of change in prices, that is the rate of inflation. The real rate of interest plus the rate of inflation is equal to the nominal interest rate. Let me see if I can make this clear with an example. Suppose the bank agrees to pay you 10% interest. So you put $100 in today, at the end of a year you're going to get $110. Your question is, how much of that money just goes to keep my purchasing power constant? That is, suppose the rate of inflation is 6%. If the rate of inflation is 6%, then of this 10% that you're getting, it takes 6% just to keep your purchasing power constant, just to keep your purchasing power from shrinking. That means the remaining 4% is actually an increase in your purchasing power. That is, after prices have risen, your $110 that you get at the end of the year actually allows you to buy 4% more stuff than you could have bought last year. So, is 4% enough to get you to save? Maybe, maybe not. Let's see if we can make the deal any better. Suppose that 10% interest occurs in an environment that has only 2% inflation. That means the rate of change in the level of prices is now only 2%. Well, that means that of this 10%, it takes 2% to keep you even with inflation, which means that the real interest rate now is 8%. You got an 8% increase in your purchasing power. Now maybe you're more interested in putting money in the bank, if that's going to be the case, because you get more stuff. So what people care about when they decide whether to save money or not is the real interest rate. And the real interest rate is a comparison between what the bank says it's going to pay and what you think prices are going to do. Now, think about this from the point of view of a business. Suppose you're a farmer and you can plant 10 bushels of wheat today and wind up with 11 bushels of wheat a year from now. So the real rate of return, the rate at which your output is multiplying, is 10%. So you'd be willing to pay the bank up to 10% interest to borrow the money to buy the wheat. However, suppose wheat prices are rising. Maybe they're rising at 5% annual rate. So you know that the wheat you buy today is going to cost less than the wheat you sell a year from now. It's as if you're going to get extra money out of this deal just because of inflation. Well, the fact that you're going to get this extra money makes you willing to pay the bank an even higher rate of interest, because the money you get next year is going to be part of what you pay back the bank. So the 10% real rate of interest plus the inflation rate of 5% adds to a nominal interest rate of 15% that you could afford to pay the bank and still break even on this deal. So what you really care about is the real rate of interest. You want to know how much purchasing power is going to be left for me, the business owner, after I've paid off my loan. The nominal interest rate is equal to the sum of the real rate of return on the project plus the rate of inflation. Now, let's suppose, for the sake of the rest of our discussion here, that inflation is held constant. If that's true, then the real rate of interest, R, is going to move in exactly the same direction as the nominal rate of interest. The bank raises the nominal interest. If inflation doesn't change, the real rate of interest goes up. So for the rest of my discussion, even though businesses and savers and everybody's concerned about purchasing power and the real rate of interest, if we hold inflation constant, we can talk about the nominal rate of interest and be talking about the same thing. Now, let's think about the demand for loanable funds. What makes businesses willing to borrow money? The answer is making a profit, right? So suppose the rate of return on a project is 10%. If the rate of return on a project is 10%, then you're willing to pay up to 10% to borrow the money. Not 15, not 20, 10. However, if you can borrow the money for 5% interest, then you've got extra profit. And if you could borrow it for 2, you're ecstatic. So what happens is we get a downward sloping demand curve for loanable funds. And the downward sloping demand curve says this: as the rate of interest increases, as the nominal rate of interest increases, holding inflation constant, as the real rate of interest increases, businesses are less interested in borrowing money because there's less profit left for them after they've paid off the bank. At high interest rates, businesses will borrow small quantities of loanable funds because there aren't enough projects that earn a high enough rate of return to make it profitable. At a low rate of interest, however, businesses will do lots more projects because more projects are profitable. There's more left for the business after the bank is paid off. That's why the demand curve for loanable funds slopes downwards. Businesses find that more of their projects are profitable the lower the interest rate goes, because there's more profit left for them after the bank is paid. Now, the next question we want to ask as we develop this picture is, what causes the curve to shift? Say we've got a given interest rate here, maybe it's 10%. And at this given interest rate, businesses want to borrow a total amount of money, say it's equal to $100,000. What could happen that would lead businesses to want to borrow more money at the same interest rate? What would lead businesses to want to borrow, say, $200,000 at this interest rate of 10%? Well, let's think about the things that would increase business profits and make borrowing money more attractive. Number one, a change in technology. Suppose a new technology comes along that allows you to replace workers with less expensive machines in your business. Or maybe there's a productivity change that makes your existing workers more productive when they use computers or some new technique. You get more output from a given amount of input, and that makes your project more profitable. And since it's more profitable, you need to borrow more money so you can build more factories and take advantage of this profit opportunity. A second thing that shifts out the demand curve is tax policy. Suppose the government cuts corporate profit taxes. That means you get to keep more of every dollar that comes into your business. Since business is more profitable, you're inclined to expand your business, and that means borrowing more money at any given interest rate. A third thing that influences this demand is increases in real gross domestic product. We've talked before about the multiplier, that is, an increase in investment spending increases GDP by a multiple. Well, there's also a relationship that works in the other direction. It's called the accelerator. When real gross domestic product increases, that is, when the economy grows, businesses decide that they want to invest more. That is, since business opportunities are obviously better, the economy is growing, investment spending increases. This is called the accelerator because the expansion in GDP feeds back into businesses' decision, leading them to spend more on plant and equipment. A fourth factor is expectations about the future. When you become more optimistic, expecting that your business profit opportunities are going to be brighter, then you want to take advantage by building a factory today, acquiring new equipment, borrowing more money at any given interest rate. And finally, what we call animal spirits. Animal spirits is kind of the herd instinct. Everybody senses that the economy is going well. Everybody else around you is investing, things are booming, so you just jump in and go with it. Or maybe your gut just tells you, now's a good time to build a factory. Who can account for animal spirits, people's instincts, and how they work themselves out in the economy? Any of these changes can lead to an increase in the demand for loanable funds, an increase in investment spending at any given interest rate. So, we show that by a shift in the demand curve. On the other hand, if things change in a way that's adverse for business, then the demand for loanable funds shifts inwards. Businesses want to borrow less money at any given interest rate. So, for a quick recap, if you look at the relationship between business investment spending and the real interest rate, you'll find that it's inverse. Higher real interest rates deter investment spending. Lower real interest rates encourage investment spending. And a little catalog of factors, including taxes, technology, and animal spirits, can lead to an increase in investment spending at any given interest rate, which we show by a shift in the demand curve. So, now we've talked about the demand for loanable funds. Next, we'll consider the supply and the behavior of savers.